partners contribute the equity capital, meaning the cash, in exchange for a share of the profits. They are passive. They do not make operating decisions. They simply invest and receive distributions. But here is what nobody talks about: the sponsor almost never uses their own money to buy the building. They typically contribute somewhere between 5 and 20% of the equity themselves, then raise the rest from limited partners. That means if you invest $50,000 into a $10 million deal, you might own 0.5% of a property you will never set foot in to manage, but you are entitled to your proportional share of rental income and any profit when the asset sells. The financial structure of these deals is where things get genuinely interesting. Most syndications use what is called a preferred return. This is a threshold return, commonly 6 to 8% annually, that limited partners receive before the sponsor takes any profit split. After that preferred return is satisfied, profits are split according to what is called the waterfall, which might be 70% to limited partners and 30% to the sponsor. Some deals use an 80-20 split. Others get more complex with multiple tiers. Always read the private placement memorandum, the PPM, carefully before committing any capital. Returns on syndication deals historically range between 8 and 15% annually, including cash flow and equity appreciation. Some value-add deals in booming markets have returned significantly more. A 2022 study by Preaching found that private real estate funds, which operate similarly to syndications, outperformed public REITs over a 10-year period on a risk-adjusted basis. That data point alone explains why sophisticated investors keep coming back to this asset class. Now let us talk about deal types, because not all syndications are created equal. The two most common strategies are core plus and value add. A core plus deal involves a stabilized, already performing property where the goal is steady cash flow with modest appreciation. Lower risk, lower reward. A value add deal involves a property with problems, high vacancy, deferred maintenance, below market rents, where the sponsor plans to renovate, reposition, and significantly increase the property's value before selling. Higher risk, higher potential reward. There are also opportunistic deals, which involve ground-up development or highly distressed assets, and these carry the most risk of all.